Welcome to our revision class today. Today we are looking at Advanced Public Finance and Taxation, Pilot Paper 2015, question number 3. I'll read the question. The promoters of June Fair Company Ltd are considering the best source of financing for their new company. The promoters are aware of the two main financing avenues for any company, which is equity or debt financing. They already have raised equity capital amounting to shillings 500 million as their base capital, which falls short of their capital requirement of 1 billion shillings. They have approached a consultant to give them advice on how to source the additional 500 million shillings that they require. The consultant has assembled his analysis into two mutually exclusive financing sources based on the promoter's request as follows. Option A, which is equity only, will have the base capital equity of 500 million shillings and additional capital, which will be through equity financing, of 500 million shillings. Total capital will be 1 billion shillings. Option B, which will be through debt financing, will have the base capital of equity 500 million shillings, additional capital through debt financing, which will be 500 million shillings. Total capital will be 1 billion shillings. It is assumed that both the additional equity and additional debt will require an annual payment of 40 million shillings and 50 million shillings for dividend and interest respectively every year. Assume that the profit before interest and taxes that the company would post for each year is 110 million shillings and corporate tax is at 30%. You are required to suggest from a tax planning perspective the best source of financing, additional financing, that the consultant should recommend. From the question, we can see we are supposed to recommend to the consultant the best source of additional financing from a tax planning perspective. Let us look at the analysis of the question before we get to the solution to be able to advise or recommend to the consultant. From the question, there are two options available for additional financing. That is equity financing and debt financing. We've been told that the company has already raised equity capital amounting to 500 million shillings, but they require additional 500 million shillings to raise a total of 1 billion shillings. We can see from the question that the consultant has assembled his analysis into two mutually exclusive financing sources, which therefore means that the consultant can select either of the two options and not both. Additional equity will require an annual payment of dividend equivalent to 40 million shillings, and additional debt will require an annual payment of 50 million shillings. We have also been given that the profit for each year before interest and taxes for the company will be 110 million shillings. And the corporate tax is at 30%. So let us look at the analysis of the question by making sure that we put down all the analysis for us to be able to come up with the solution. So we are looking at September 2015 pilot paper question number 3. So the question analysis are as follows. Additional capital required, is 500 million shillings. We have also been told that the consultant can either choose debt financing or equity financing and not both. So the consultant can choose debt financing or equity financing and not both. Additional equity will require annual dividend payment of 40 million. So additional equity will require annual dividend payment of 40 million of shillings, 40 million. Additional debt will require annual interest payment of 50 million. Additional debt will require annual interest payment of 50 million shillings. We've also been told profits before interest and tax will be shillings 110 million. So profits before interest and tax will be 110 million. Corporate tax has been given at 30%. Corporate tax has been given at 30%. Before we get to the solution, we need to understand what we require to be able to recommend the best source of additional financing. To be able to determine the best source of additional financing that the consultant should recommend, we need to find out the best option among the two, that is debt financing and equity financing, that provides the company with more revenue from a tax planning perspective after deduction of interest, taxes, and dividend. So we are going to look at the solution, and from the solution, we need to determine between the two options which option, after deducting interest, taxes, and dividends, allows the company to remain with more revenue for purpose of investment. So our solution is to determine the best option between the two, that is debt or equity financing that allows the company to remain with more revenue at the end of the year after deducting interest, taxes, and paying out dividends. So the solution is to determine the best option between the two, i.e. debt or equity financing, that allows the company to remain with more revenue at the end of the year after deducting interest, taxes, and paying out dividends. To be able to do this, we will have two columns for equity financing and debt financing. So we'll have here equity and debt. Our figures are in millions of shillings. So when we look at our analysis, for you to be able to arrive at deducting the dividend, we have first to deduct interest from the profits given, and we proceed to deduct taxes. After that, we will then deduct dividend and be able to know how much revenue of the two options is available for investment. So from our analysis, we know that profits for each year so for both options, the profits will be the same, 110 million. From the profits, we need then to proceed and deduct interest on debt, so from the profits for each year, we need to proceed and deduct interest on debt. From our analysis, we were given interest on debt is 50 million. So for the equity option, there will be no interest. For the debt option, our interest is 50 million. So profits after interest for the equity option, we remain with 110 since there is no interest on debt. For the debt option, 110 less 50, 110 less 50 gives us 60 million. After arriving at the profits after interest, we need to deduct taxes. We need to deduct taxes from our profits after interest. So we need to deduct corporate tax, which from our analysis is at 30%. For the equity option, the taxes will be 110 multiplied by 30%, which gives us 33 million. For the debt option, our profits after interest is 60 million. Our taxes therefore will be 60 million shillings multiplied by 30%, which gives us 18 million. So our profits after interest and tax, for the equity option, we have 110 less 33, which gives us 77 million. So for the equity option, the profits after interest and tax is 110 million less 33 million, which gives us 77 million. For the debt option, our profits after interest is 60 million. So our profits after interest and tax will be 60 million shillings less taxes, which is at 18 million shillings. That gives us 42 million shillings for the debt option. 42 million shillings for the debt option. After the profits after tax and interest, we need to deduct dividend payable for both options. We need to deduct dividend payable for both options. From the analysis and from the question, dividend payable per year will be 40 million. Dividend payable per year is 40 million for the equity option. Dividend payable per year for the equity option is 40 million. Dividend payable for the debt option will be nil. Dividend payable for the debt option will be nil. After that, we get profits after interest, tax, and dividend payable. After that, we get our profits after interest, tax, and dividend payable. For the equity option, the profits after interest and tax are 77 million shillings. Dividend payable is 40 million shillings. Our profits after interest, tax, and dividend payable, therefore, our profits after interest, tax, and dividend payable, therefore, it's 77 million less 40 million, which is the dividend payable. That gives us 37 million. So for the equity option, the profits after interest, tax, and dividend payable is 37 million. For the equity option, there is no dividend payable. For the for the debt option, there is no interest payable. There is no dividend payable. For the debt option, there is no dividend payable. Therefore, our profits after interest, tax, and dividend payable will remain 42 million. Our profits after interest, taxes, and dividend payable for the debt option will be 42 million. Therefore, from the two options, we can see the profits after interest, taxes, and dividend payable for the equity option is 37 million shillings. For the equity option is 37 million shillings. For the debt option is 42 million shillings. For the debt option is 42 million shillings. From our solution, we were to determine the best option between the two options, that is debt financing or equity financing, that allows the company to remain with more revenue at the end of the year after deducting interest, taxes, and dividend payable for purpose of investment. And therefore, from the solution, we can see the best solution, the best debt financing, the best financing option is debt financing. From our solution, we can see our profits after interest, tax, and dividend payable for the equity option is 37 million. For the equity option is 37 million. For the debt option is 42 million. For the debt option is 42 million. From the solution, we were supposed to determine the best financing option of the two, that is debt financing or equity financing, that provides the company more revenue at the end of the year after deducting interest, taxes, and paying out dividends. And as we can see, for the equity option, we have 37 million profits after interest, taxes, and dividend. And for the debt option, we have 42 million. Therefore, based on this, the best option for financing available for the company is debt financing. And the reason is the debt financing provides the company with more revenue at the end of the year for investment purposes after deducting interest, taxes, and dividend. Debt financing provides the company with more revenue after deducting interest, taxes, and dividend payable, and therefore the company will have more revenue at their disposal for other investment activities. Thank you very much. We have come to the end of our class today. We shall be having more classes on the same subject. Thank you very much.